Kevin Green joins me now to get across some of these numbers, and we are just getting our ISM manufacturing, which has been released as we speak. What are you seeing there, Kevin?
Yeah, I would say this is actually a mixed report, Sam, when you're looking at not only the manufacturing PMI headline as well as prices. So the headline number actually came in at 49.1. So it's still in contractionary territory, but it's slightly better than the street's expectation, which was sitting at around 49, and better than what we saw for this time last month at 48.7. The prices component still elevated at 61.9, so that's still an expansionary territory, meaning prices are still rising, but it's decelerating. The street was actually looking for 62.7 on that prices component. This time last month, the prices component was sitting at 63.7. So once again, a little bit mixed. Price is still elevated. You had the headline number for the most part coming in line a little bit better than the street's expectations. Only big outlier that you're concerned about, new orders. So new orders actually did miss the street's expectations. That came in at 48.9. So that's actually contracting. Street was looking for a flat 50 reading on that number. This time last month, new orders are sitting at 51.4. That's not really what you want to see. You want to see new orders expanding, prices coming down, and that overall headline number for PMIs actually moving a little bit higher. Now, manufacturing is only about 30 to 35% of the total economy, so we have to be mindful of that. The ISM services carries a little bit more weight, but I would say a mixed picture at best, especially given the backdrop that we have for the labor market with that ADP report today. I would say this is kind of mixed, but still not really budging the Fed, most likely, in one way or another when it comes to the direction of inflation as well as the overall economy.
Okay, yes, it was the new orders, actually, that was the fly in the ointment in the Eurozone PMIs overnight as well. I believe new orders are falling at the fastest pace in around 6 months, so we are certainly seeing that across the board. S&P PMI numbers as well. Just tell us what you're seeing there across the board.
Yeah, so for manufacturing PMI from the S&P Global, that came out about 15 minutes ago. That came in at 52. That matches the street's expectations, a little bit lower than what we saw for last month, which was sitting at 53. Not as big of a mover when you're looking at the S&P numbers compared to ISM, but it's something that we have to obviously take note. And if we are not going to be able to get government data when it comes to the labor market and the conditions of the economy, then a lot of this third-party data or privatized data is going to be a little bit more meaningful over the next couple of weeks, potentially, if this shutdown does continue. So overall, let's just say it's a murky picture for manufacturing just in general. Nothing that we saw in this report from ISM or S&P Global shows that we are falling off a cliff or we have a rapid spike when it comes to prices, which kind of leads to inflation. But the new orders component is a little bit of a concern. You want to start seeing that actually moving a little bit higher. As you get more in new orders increasing, generally employment does increase as well. Overall sentiment for the industry, especially if you're looking at manufacturing, also improves. So that's the direction we would like to see.
Yeah, it seems like these data points are uncharacteristically more sort of heavily weighted, given that we're not likely to get that NFP. In Ben Emmons' words, ADP and ISM are the NFP this week. So just as far as we got with the ADP, a big drop, surprising decline there, minus 32,000 versus estimates of around just over 50,000. That was plus 50. So, I mean, what does that tell you when you look under the hood as far as what was up, what was down? I mean, it was only a positive category across healthcare and education, perhaps no surprises there. But I thought construction looking negative was interesting, particularly given all this talk of onshoring, reindustrialization, data center build-outs, etc. What are your takeaways?
Yeah, we need to, I don't want to say take this report with a grain of salt, is definitely going to be meaningful, but if you do look at the internals as well as the footnotes from ADP, you'll have to kind of question maybe some of these numbers. And I don't want to say question them, but it would be nice for us to have the BLS report to really kind of clarify what we are actually seeing in the labor market, no doubt. If you look at these numbers, a couple of things. I have 3 things that I want to be able to highlight. First and foremost, we had a negative print. Obviously, that's been the headline this morning. This is after the ADP adjusted its numbers to reflect the quarterly census and employment and wages data that we had last month. Remember, we saw this massive reduction in the BLS data points because of obviously more data hitting the market. and being a little bit more accurate, they already have now adjusted because of those BLS adjustments, if you will. So you did see a reduction of around 43,000 jobs in September because of the adjustment with the benchmark in general. We also did see a revision, a pretty decent sized revision for last month as well, going from, I had the number here, going from, it was around 53,000 jobs. Now we showed basically a job loss of around 3,000. That's also in relation to those benchmark adjustments. Another key thing to highlight, if you look at this, the geographic regions, the Midwest region lost 63,000 jobs, or if you're looking at jobs being added, lost 63,000 jobs. That's something of a little bit of an outlier. I would kind of note that moving forward as well. ADP will now report their numbers based on that benchmark. The BLS does not make that adjustment until January, so we will see a divergence moving forward for the remainder of the year between ADP and BLS. We have to be mindful of that. Last thing in the footnotes that we also have to kind of talk about, there was a significant amount of missing data from the federal government for these benchmark revisions. So the ADP actually had to back in and try to come up with these numbers in order to obviously produce this data set. So there is some missing data sets coming from the government itself. Just giving that overall backdrop, yes, very volatile number. Can we really trust it as far as the true outlook of the labor market? I would say questionable at best, but it's the only thing that we have at this moment.
Yeah, absolutely. I suppose the big question for the markets and investors now, Kevin, is just how long this thing is going to actually drag on for, because it won't become a problem until it really does, so to speak. And I mean, you know, for now, it looks like there's still a 95% chance of the Fed cutting in October as far as what the market's pricing in. So let's see. Thank you so much for getting us across those critical data points this morning, KG.